Welcome to the Wealthfinity channel, where we share tips and strategies for building wealth and achieving financial freedom. In this video, we're going to be discussing exploring the inflation rate in Russia, understanding the factors and historical trends. Whether you're just starting out on your financial journey or looking to take your wealth building efforts to the next level, this video is for you. So sit back, relax, and let's get started on the path to financial success with Wealthfinity. Inflation is a measure of the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. Russia's inflation rate has been a topic of concern for economists and policymakers for some time. In Russia, the inflation rate has been a significant concern for policymakers, investors, and consumers alike. The Russian government has taken a number of steps to address inflation in recent years. Additionally, the government has sought to diversify the economy and reduce its dependence on oil exports. We will delve into the causes and effects of inflation in Russia, as well as the measures being taken to combat it. In this video, we will explore some of the factors that are influencing Russia's inflation rate. It is often measured by the Consumer Price Index, CPI, which tracks the prices of a basket of goods and services that are commonly purchased by households. One of the main drivers of inflation in Russia is its dependence on oil exports. The country is one of the world's largest oil producers, and fluctuations in the price of oil can have a significant impact on the economy. When the price of oil is high, Russia's economy tends to grow, leading to increased demand for goods and services and, subsequently, higher prices. On the other hand, when the price of oil is low, the economy may contract, the Russian economy suffers, and inflation tends to be high. The effects of this hyperinflation were devastating for the Russian economy and population, as it led to a sharp decline in living standards and widespread poverty. The cause of this hyperinflation was a combination of factors, including the government's policy of printing money to finance budget deficits, the liberalization of prices, and the breakdown of the Soviet-era system of price controls. Another factor contributing to inflation in Russia is the country's lack of diversification in its economy. The country's economy is heavily dependent on natural resources, which makes it vulnerable to fluctuations in commodity prices. Additionally, the country's manufacturing and service sectors are underdeveloped, which limits the ability of the economy to create jobs and generate income. Another influencing Russia's inflation rate is the country's monetary policy. The Russian central bank has implemented a number of measures to combat inflation, including raising interest rates and implementing monetary policy measures such as quantitative easing. The bank has also been using its foreign exchange reserves to stabilize the value of the ruble. Throughout the Soviet era, inflation in Russia was kept in check by the government's strict control over prices. However, after the collapse of the Soviet Union in 1991, inflation in Russia soared as the government struggled to transition to a market-based economy. In the early 1990s, inflation reached triple-digit levels, reaching a high of 2,500% in 1992. However, in the aftermath of the global financial crisis of 2008, Russia experienced a resurgence of inflation, reaching a high of 8.8% in 2010. The cause of this inflation was a combination of factors, including a rebound in oil prices, which is Russia's main export, and a rise in food prices due to droughts and other weather-related factors. Additionally, the government has sought to diversify the economy and reduce its dependence on oil exports. In the mid-1990s, the Russian government implemented a series of economic reforms, including tight monetary policies and a tight fiscal policy, which helped to bring inflation under control. Inflation fell to single-digit levels by the end of the decade, and remained relatively low for the next decade. The Central Bank of Russia, CBR, is responsible for setting monetary policy, including interest rates and the money supply. When the CBR raises interest rates, it makes borrowing more expensive, which can slow down economic growth and curb inflation. However, when the CBR lowers interest rates, it can stimulate economic growth and increase inflation. The sanctions imposed on Russia by the international community have also had an impact on the country's inflation rate. These sanctions have limited Russia's access to international financial markets and made it more difficult for Russian companies to borrow money. This has made it more expensive for Russian companies to finance their operations and has increased the cost of goods and services. Another factor that is influencing Russia's inflation rate is the country's population and demographics. As the population of Russia ages, there is a greater demand for healthcare and other services, which can drive up prices. Additionally, as the population grows, there is a greater demand for housing and other basic necessities, which can also drive up prices. In conclusion, the inflation rate in Russia has been affected by various factors such as oil prices, government policies, and global economic conditions. Throughout history, Russia has experienced periods of high inflation, but has also implemented policies to successfully bring it down. Understanding the factors that influence inflation in Russia is important for both policymakers and investors. The video has explored the historical trends of inflation rate in Russia and highlighted the key factors that have contributed to its fluctuations. It is now up to the viewer to continue to stay informed and stay updated on the current inflation rate in Russia and the various factors that may affect it in the future.